Hello, everybody. Good afternoon. Good morning to you all. My name is Lady Mary Bourdu, and I am your host for the chat room, a platform dedicated to resolving daily life's issue. Over here, we talk of things of reality. We have important conversations that would benefit our community, the society at large. We provide information that would benefit your home and that of mine as well. It's January 2026. Can you believe it? So soon we are here into the new year. And I'm excited because I believe that there is going to be a lot of great things in this, great things happening in this new year. So today, Sunday, today's the 4th of January. And as always in the chat room, we look at everything, like I said, that will benefit your family. So we're looking at our finances for this year. Okay. How are you budgeting? How are you managing? How are you saving? How are you planning and preparing for yourself and your family at large? And so I have with me our amazing guests that would be introducing themselves to you soon. But as we always do, we would like for you to take a few minutes and share the broadcast. We would be right with you as you take some few seconds to share.
Yo, yo, yo. Now your matter with the talk. Your life, your wahala, your breakthrough, the day. Welcome to the chat room.
This no be ordinary place. Now a solution they show face. Lady Mary, they lead the way. With guess where go blow your brain. Talk your matter, make we solve 'em. No judgment, just love and wisdom. We they discuss, we they learn. Every episode you gon' feel the burn. Oh, the chat room. Now here we define the way. Oh, the chat room.
Oh, yes.
We go talk and clear, no delay.
No delay.
Oh, it's interactive, educative, informative, and unapologetic. Oh, the chat room. We unstoppable, no be lie.
You.
Hey, the chat room. Hey, now here we can find a way. Wow.
All right, so I'll bring our guest on for today. I am not sure where my co host is. Apparently, she's on, but I don't see her. I do not see her, but I'll bring our guest on and we'll make sure that. Okay, there she is. I couldn't, hey, I couldn't hear you, Nana. Can you hear me?
Yeah, I can hear you. Can you hear
That's
me?
weird. Yeah, I can hear you.
I was
Okay,
there.
so yeah, I see what happens. Thank you so much for being behind the stage, Mr. Collins. Jeez, I'm like, where is she? All right, so Nana, I'm not sure what just happened, but it says that the system failed to play the commercial. I'm not sure. So I'll let our guests introduce themselves and then we'll come back and replay. Is that okay? Okay. So please, Miss Letitia, if you can hear me, please introduce yourself. Then we'll give it over to Miss Felicia. Then our co-host would introduce herself. Please go ahead.
Absolutely. Thank you so much for having me. It's such an exciting time. 2026, we're so grateful we're all able to make it. Thank you for having me as a guest. My name is Letitia Chipcorn, and I'm a licensed financial professional. I help individuals turn uncertainty about money into clarity and long-term financial security. I have been helping families and individuals for about 5 years now, and it's such an honor and pleasure to be here. I'm looking forward to having this discussion with you, so we can help a lot of people, especially in this new month of the year. So pretty excited. Thank you.
Sure, Miss Felicia, please go ahead.
Okay, my name is Felicia Menu. I'm also a licensed professional, and Letitia helped me and my family to put our finances into proper place, and therefore I joined her to come and help us out this 2026 to see how best we can help each other put our financial situations together. Thank you.
Okay. Did everybody hear her? Because her internet was not it wasn't cooperating.
My voice is too small,
You heard
too
me.
low.
Okay.
You heard me? Okay.
No, that's fine. You're fine. They said they heard you, so I'm thinking that our viewers or our listeners also heard. Nana, yeah, please take over. Introduce yourself first, Nana.
Good evening, everyone. I'm trying to set up my lighting. I don't know what's going on.
You're
Um,
good.
yeah, I'm a little bit in the dark. But yes, my name is Sanaya Sarpong, and I am the co-host. I'm glad to be here. Again, last week I was out a little bit, but um, I was tuning in here and there, and it was a great conversation. So we thank all the guests that accepted the call, and thank you all today, Miss Felicia and Leticia, for joining us. I am a mother, a wife. I used to be, well, let me not say I used to be. I used to be in banking. I'm not in banking anymore, but I'm still in the financial sector. I deviated a little bit, um, went to try some other stuff, but I'm back in finance. I'm not a licensed professional. I actually work for a local government managing some of their fundings. So that's my my 9 to 5, and on the side I run Ubianana, which is an African print inspired fashion line. So I'm excited about the conversation today.
All right. So I will take this quick commercial break and let's see how it goes this time. We'll be right back.
Yo, yo, yo. Now your matter with the talk. Your life, your wahala, your breakthrough, idea. Welcome to the chat room.
This no be ordinary place. Now a solution they show face. Lady Mary they lead the way. With guess where go blow your brain. Talk your matter make we solve 'em. No judgment, just love and wisdom. We they discuss, we they learn. Every episode you gon' feel the burn. Oh, the chat room. Now here we define the way. Oh, the chat room.
Oh, yes.
We go talk and clear, no delay. No delay. Oh, it's interactive, educative, informative, and unapologetic. Oh, the chat room. We unstoppable, no be lie. You, hey, the chat room. Hey, now here we define the way. The chat room. We go talk and clear, no delay, no delay. It's interactive, educative, informative, and unapologetic. Oh, the chat room. We unstoppable, no be lie.
We are back again. Happy New Year to everyone once again. If you are watching us on YouTube or Facebook, please do well to hit the share, like, and comment. Invite other people to join. I think that this is an appropriate time to really look at our finances, okay? See how we can best manage them. Nanaya, please take over. Thank you.
Okay, is my connection okay? Because I feel like
You're good.
um,
You're
maybe
good.
you were cutting off a little bit here and there. Is my connection okay?
Yeah, you're good.
Okay. So um, this is a conversation that I am passionate about because personally, I feel that if financial education is not, there's not a lot of it out there. You know, you're put in life, and even in school, you're really taught everything else, but really like life financial skills. And even with me, when I said I used to work in a bank, you know, things that I know now, I did not even know then I banking sector. So that's why this is important. that we, educate our community. So to be just to begin, Miss Felicia did say that, and if I'm not saying your name right, please let me know. It's Letitia.
Yes, Letitia. That's right.
Is that correct?
Mm-hmm. You got it.
All
Yeah.
right. She did say that you helped her in her financial um, aspect. So can you tell us a little bit about that, about exactly what was needed and what you did before we like go into deep, just to kind of give us a brief um, beginning about what was done.
Absolutely. So I did meet Felicia about, I want to say, maybe 2 years ago, and through another friend actually, and when she came in, we talked a little bit about what her financial goals are, her and her family, and she told me that she had an encounter a few years back, and she had put some things in place and kind of like was set in a lot of ways, but she was interested in learning more and actually just being more involved, given the fact that the decisions that she had made at the time were something that she was really proud of and wish that she knew some of those strategies earlier. And so she wanted to get licensed and learn how she can help other families. And that's how she came on board. And she's just been learning and in turn, and I'll let her speak for herself also. She's been able to help a lot of people as well. So a few weeks ago, maybe 2 weeks just before Christmas, she did call me and told me about your show, and that Lady Boadu had, Mary had reached out to her, and I was definitely very interested. I'm always very happy to jump into any conversations that are gonna like just bring our community forward. And just like you mentioned, you were in the banking sector, so you have a little bit of a background in finance, which is really great. And I meet people like you every day, especially from our communities, and you find that this is a topic that is not talked about in our academic system, and especially if we're talking about our communities. I mean, when I say our communities, I'm talking about the African immigrant communities and just largely the middle class, that you find that that is an area that is really lacking. And so I come from a background of nursing, by the way. I was a registered nurse, and I was for a good number of years, maybe about 9. Well, some of those years just in healthcare. And then, but one of the things that I really struggled with is I felt like I was making decent money, but I really lacked even the basic understanding of how the system here works, and just even simple things like budgeting, savings. Yeah, I could save, but it's like, okay, I just have it sitting in my bank. So when I eventually met someone who was able to share some knowledge with me, and I just felt like this is an area that we all need help in, and that's how I decided to get licensed. And so just been working with a lot of people since then. For the last 5 years, we've really been able, and just to help a lot of people. And I just feel like there's still a lot of work to be done. So definitely these conversations are really, really needed. Yeah.
Okay, thank you. Miss Felicia, can you tell us about your experience and how you came to meet Letitia and what was done for you?
Thank you so much for inviting me. I speak very soft, so if you guys don't hear, let me know. Anyway,
We can
it
hear
was
you.
about 2010, 2011 when I was introduced to this financial platform. But like Miss Letitia said, I really did not understand much of it. And I did not know the in depth of how this can help me. So I just did very minimal, very minimal. And I did not even take my time to study or learn. Fast forward 2023, just like she's saying, a friend of mine brought me back to the same platform. I was so reluctant, I didn't even want to. But after hearing her and connecting with Miss Letitia, I saw that I'm way behind, and there were so many things that I could have learned that I did not. So this time I said, I'm just logged in. So I got my license, and Miss Letitia has been mentoring me and teaching me. And so I felt it's the best opportunity for her to come here today and talk to us about what we've been doing. Thank you.
Okay, thank you. So, I would say if someone, let's say, like I was saying, I work in banking, but I didn't really know about financial management, right? You have your checking account, you have your savings account, you work, you basically work to pay bills. And sometimes once you feel like, oh, the bills are paid, then you have the mentality that I can splurge, I can go and spend, I can do this, I can buy a car, I can do this, I can do that, right? So I want to start with the people who are just starting their adulthood, right? So somebody graduate from college and they get their first job. What would your advice be in managing their finances? What kind of structure would you tell them to put in place?
Absolutely. Great question there. So, yeah, I do believe that as long as you have an income coming in, and we have our kids, right? The teenagers, they start a job, they probably even just after high school and they're waiting to go to college, or maybe they're in college and they have their little job working something, minimum wage. I really do believe that we should even, like, as as parents or like caretakers, or guardians, that we should already would have started having this conversations earlier on. So I would advise anyone who has a job, I would advise our young people just starting out in college, and I'm going to be sharing my screen a little bit to just talk about some of those foundational frameworks that people can start from. But at that point, I would think that this person is in college, maybe hopefully they have a scholarship, or they have some money that was put aside for them to pay for this college tuition, so they don't have to take student loans. But see, situations are different. Some people pay, they have to pay their way through college. But let me just assume, and that's a typical kids in the in our communities, households. So you have somebody that's paying their way through college, and there's hardly anything left. But and then you're also going to have maybe some lucky ones that their parents put away a little something for them, or maybe they're in school on scholarships. But irregardless of all of that, I would advise that uh, um, people can do self-education on basic financial management concepts, personal finance. Okay. We should be able to, pay off all your bills, and then, find a way that you can have these savings in an environment that's going to give you growth and stability. And also, taxes is a huge one. So you want to find out, the goal is to always make this money work for you. So we want to use the best strategies that are going to help us stop losing this money. So we want to understand what are some of the ways that we lose money. One of it is taxes. One of it is probably paying management fees and things like that. So you want to find an environment outside of the bank that they can, even though it is just like little, it adds up with time, especially when you use concepts like compound interest. And this is actually the best time to start doing that in their early teens, so that by the time they're going, or even sooner, so that when they get into their 30s, that compounding effect, they are leveraging the time that is working in their favor. And at least when they're done with school and they're off to their careers, they can always dip in, start a business, take the money out, just stay out of debt. So I would advise people, or our young youth, to do self-education. There are so many books that talk about personal finance. And then the second best thing is to find a licensed financial professional or a professional that can really guide them in the right direction. Absolutely. And so
Okay.
yeah, sorry, go
Go ahead.
ahead.
Go ahead.
Yeah. Um, I wanted to share I wanted to share some information that I had here with me that is really, I feel like maybe when we use the visual, people are able also to like maybe take screenshots and then they can ask questions later or follow through. I'm not sure if that's okay. Can I go ahead and share this? Yeah. Thank you so much.
Yeah, just let me know when you're ready to move on to which page, and then
I
I'll
see.
do that for you.
Okay, so you're going to be the one controlling it?
Yep. Yes.
Okay, no worries. So now we're talking about the new year, 2026. By the very exciting, only the fourth day of the year. What a day to be able to talk about such a topic, because most people, one of their when you hear people, when you talk to people about their New Year's resolutions, the top three things that they're going to tell you is to work on their finances. But unfortunately, statistically, you're going to find that most people fail. Most people, their financial goals fail. And we all start the year with good intentions. We're very excited, but I want to give you some reasons why. If you just by writing a goal down is not enough. So if you're one of those people that you wrote some things down, maybe you want to save 50,000 this year, maybe you make about 100,000, you want to be able to save at least 50 or 60%. That is very possible, but you have to have a plan and a good strategy. And these are some of the reasons why goals fail. Number one, there's usually no clear financial vision. You just have a vague goal, like, okay, so these are my goals, but what is the strategy? How are you going to get there? So people have no system behind these goals. And also, there is little protection against life and market risks. In as far as you can have all these goals, we also have to think about risk management, because life is going to happen. So as we wish for the best, we also have to think about, what if this was to happen? How can I protect my goal, right? And then also, another thing is there's too much focus that is placed on a product instead of understanding the strategy. So we have to, first of all, learn the strategies. Like I spoke a little bit about some of the principles that can guide people, but we tend to focus so much on the products, and then we end up writing off a lot of products just because we think we know what it is. So we don't give ourselves an opportunity to learn about, what strategy are we going for, right? So yeah, you can go ahead on the next one. Thank you. Okay, so thank you. So when we're talking about today's topic, the topic I was given was, having a clear financial vision for the year 2026. So every strong financial plan is built on three main pillars. The first one is protection. The second one is growth, and the third one is access. When we talk about protection, you want to think about where you have an income coming in. Okay, we all have an income. You have a job, or maybe you have a job, you have a business. So obviously, to be able to have that financial freedom, we have to first of all protect what we have, safeguarding that income, protecting your family. Because when you don't have income coming in and there's no income replacement plan, then your family suffers and then your future suffers. It goes in that order, right? And number two, the second pillar is we have to talk about growth. After we protect it, then we need to find ways to be able to make sure we grow that money. Okay. So building wealth intentionally and also efficiently by using methods that can help you achieve those goals. And number three, the third pillar is being able to have access. being able to have access, because when you need something, you need to be able to dip into that money and take it out when you have an emergency or just need to spend some money, maybe vacation for your family or whatever the reason may be. You need to have flexibility and control and avoid places that are going to penalize you just because you wanted to access your money. And so, having talked about, mention all these three pillars, if one pillar is missing, the plan becomes unstable, right? So I hope you're following through. Yeah, so we can go on to the next slide. So now let me talk more about the first pillar also, which we talked about. They are all very important, but that is the first one, is protection. So this is about preparing for the unexpected. So you want to ask yourself these questions in this coming year, right? What happens if I cannot work? What happens for whatever reason? Maybe you had to travel and see your parents or your other family that live in another part of the country that they needed you. That means, and this, that means you're not going to be able to work. So when you don't work, there's no income coming in. So, or maybe your teenage daughter needed you and they're going through some things that they need their parent to just spend some time with them. And you know how kids can be sometimes. So there's a critical period that they are in and you just have to be closer to them. So whatever the reason might be, you want to ask yourself in this coming year, what happens if I cannot go to work today? And then also, what happens if I live longer than expected? Okay, we all want to live a long life, right? This is just a joke, but I don't know why it is, but every time whenever I help my clients and I show them like illustrations and we're trying to customize something for them, I have this habit of stopping at age 93, right? And I'm always thinking, okay, maybe I'm supposed to live to age 93, right? But so you want to ask yourself, what happens if I live longer than expected? Because an average American is going to live for 30 to 40 years after they retire at the age of 65, 67. And I think you can agree with me that that's a very long time to be alive without a plan. Don't you agree? That's a very long time to be alive without a plan. So you want to think about retirement. And then also you want to think about what happens if the market drops at the wrong time. Okay, the market always drops every 5 to 6 years. The economy has a way of balancing itself, and you're always going to see, a recession and inflation happen. If you look at the historical performance of the U.S., even in the last 20 years, every 4, 5, 6 or so years, there's a dip in the market, and people lose a lot of money. So this is a fact. Most people are more exposed to risk than they actually realize. So you want to think about those things as you plan for those financial goals this year, okay? So the second pillar is growth. So now we have talked about protection. We understand that it's very important. After we protected our money, then we need to figure out how we can grow it. So the right way. Growth should support your life. It's not supposed to stress it. It's supposed to give you peace of mind. And the right growth strategy considers these three things, okay? Tax efficiency. What you want to understand is whatever choices we make or whatever accounts we decide to use to save our money this year, it's going to fall into two categories. You can either use a tax efficient method or use a method that is not going to be tax efficient for you. So you want to be thinking about accounts or portfolios that you can use that will give you tax advantages. So I always say this, when it comes to taxes, yes, pay your taxes. We're not telling people not to pay taxes, but you also want to make sure that you're not using a strategy that you could have used something else and would have otherwise saved you a whole lot of money. And then you also want to think about protection from major losses. And major losses can be even things like sickness, right? You get a critical or chronic illness, God forbid, but now you lost your job, so you don't have health insurance, so you don't even have short-term, long-term disability, and your savings are all gone. And then you start this GoFundMe's that people are going to contribute whatever they can, but by the second or third time they would still want to help you, but everybody has their own problems, right? So these major losses, you need to think about having an income protection that can still pay out to you as if you still had a job, or even better. So that way your lifestyle doesn't change. You can still pay your mortgage. You don't have to lose your house. Your kids can still maintain the same lifestyle, and then you can focus on things that can get you back on your feet. And then so
Okay. Sorry.
Mhm.
I don't want to forget my questions, and I think I was gonna wait until the presentation and then come
Mhm.
back and do follow-up questions. But I think we should address it as we go, so
Yeah, that's
we don't forget anything. So going
sounds.
back to protection, right?
Mhm. Mhm.
Going back to protection. When you said protection, what I'm thinking about is insurance, right?
Mhm.
Which people usually leave their money in the bank
Right.
because they feel secure, right? If something happened, if the market crashes or if something happened, then they have protection. Their funds are protected, right? But of
Right.
course, we want to grow. So let's talk about the protection aspect of it. What do you mean? And suggest some type of like accounts or ways that people can protect their funds. As you go on, so we can kind of like cover everything. So let's go back to that protection part. And what are some ways that people can protect their funds or protect their livelihood in general?
Yeah, yeah, absolutely. So when we talk about protection is, so I have an income, I have my money coming in, and so of course I pay my bills and what needs to be paid and all of that, and then for whatever is left after that. So yeah, protection. So when most people, we all have a bank account. When you have a job, you have to have a savings checking account. That's where your income comes through, right? Your paychecks, right? So when we talk about, let me talk about the banking strategy, because that is what a lot of people can relate to.
Hmm.
So when you have, you let your money sit at the bank, okay, it's in your savings account. When I'm talking about protection, is protection from, you don't want to lose it. You want to protect it so that you can have something to start off with when, if you want to save and start investments and things like that. So the mistake that a lot of us make is we make a mistake of thinking that just because I have $10,000 sitting in my bank account that I am good. I log into my mobile, banking, and I see my 10,000 is still sitting from 2 years ago. But we don't understand that it's not protected, because the face value of what I'm looking at right there, we have to think about inflation. The average inflation in America is about 3%. So it means that if I have a dollar, I mean, I bought this pen for $1 this year, the cheapest I can afford next year, the same pen, I'm going to need 3 more cents to my $1. So I'm gonna need more, right? So the same $1,000 that's sitting in my bank today, it is not protected just because I'm able to log in and see it. So some of the ways that we need to protect our money is for example, the example I just gave is inflation. You want to be able to move that money and rechannel it into something that is able, or a portfolio that is able to give a rate of return that is higher than the inflation rate. In that way, you have protected it. So if I have this money and I make investments, and I make sure that I'm getting a rate of return that is like about 3% or 4 or 5 or that, I have protected that money, because that means that I'm able to compete against the
Inflation, the
yeah,
market.
inflation, the market. So that is one way you want to look at it. Another way, when we talk about protection, is protection from things like management fees, for example. There are certain accounts that I'm going to use, and regardless of whether I'm making money in those accounts or not, I am going to be required to do what? To pay management fees. And they vary. they from 2%, 3%, even 4%. I'm going to take an example of like also a 401k is what a lot of people are very have, or any employer sponsored portfolio. Their management fees go anywhere from 1.5 to 3%. So let's say we have a 30-year-old today. They have 100,000 in their 401k. They are planning to use this money for retirement, and every year they are paying about 2% of that 100,000 in management fees to a financial advisor. That is whether they're making money or not, whether the market was good in those years or not. And as we always know, the market is always going up and down. You're going to pay 2% of 100,000, for example, until retirement. 2% of 100,000 is $2,000. If I still have 37 years to retire, that is 2,000 times 37, that's $74,000. Have I really protected that money? That is a lot of money that I could have protected it by using a different avenue that I don't have to pay management fees. Those are some of the ways that we can look at protection. Another thing is taxes. What if I could use a strategy that I don't get double taxed on? Again, let me talk about the bank account, because everybody knows that one. And say I have, any bank right here that is giving me an interest of 0.1%, for example, because that's usually the figures, right? So let's say I make 100,000 last year from my nursing job. That 100,000, 0.1% of that, I would have made an interest of $100 in that account. This is already money that's coming in from my employer that has already been pre-taxed, state and federal, depending on where you live. So this is already pre-taxed money. It's already been taxed as income, and it's coming in. And then at the end of the year, and then I go to Walmart, I go to the store and buy food for my kids. I take care of my family, and every little money that I spend out of that pre-tax dollar is also taxed on any goods and service that I want to get. And at the end of the year, I make 0.1%, $100. I get a tax document from the bank telling me that it's called a 1098 during tax season, and you're supposed to report that $100, that miserable $100 that you're supposed to report, and also pay taxes on that little $100. So we haven't protected that. And see, all it takes is just knowing the right strategies, and then avoiding the ones that are not going to protect your income, right? So that's what I mean by protection. And there's so many other ways also that we can protect our money.
Okay, so just to bring it home to, let's say, people that are not financial savvy, right? We want to kind of break it down to them. And so what I'm understanding is that, okay, so, and like I said, starting from someone, and we will build it up to, people older, because some people are close to retirement and still living paycheck to paycheck, and still have like savings, and they're depending on their savings. And that's like, they like going to the bank and seeing the money there. And even if they're getting like, 0.0001%, it's there. They can see it, they can go and look at the account and see the numbers and be okay with it. So the college student that just graduated and got their first job, right? What I'm understanding is, of course, you want to have your transactional accounts, which is the accounts that you use daily for your activities. Your direct deposit comes in, you use it, mortgage, bills, whatever, right?
Yeah.
Should we also, because that's where I guess the tug of war comes in, having savings, are you saying that since the savings is, I guess, minimal on interest, you won't advise savings? Like, what are you saying? Like, what type of accounts should they have, just to say, okay, should they have maybe a checking a savings, and then maybe something long term. Think about like, you know, yeah, you have your 401ks, but think about something that you can also invest on your own that can be tax free at the end because you already pay tax on it.
Mm-hmm.
Um, is that what you're saying?
Yes, yes. Thank you so much for that. That's a great, great observation. And so, of course, you have a bank account, you want to have naturally will come with a savings account also and a checking. So, like you mentioned, that's something honestly we cannot run away from the bank because, like, there's just something it gives us when it comes to accessibility. You just need to go take some money, you have a credit card and things like that. So, I am not saying that people should not have bank accounts or savings accounts at all, but you also want to think long term. We're thinking about financial planning. We're thinking about being able to make our money work for us. So, absolutely, everybody should have a strategy outside of their savings and checking account. The banking, the bank portfolio, savings, checking, and a CD is not a long term financial portfolio. That is not going to get anyone where they're trying to go in as far as achieving that financial freedom, in as far as like being able to comfortably afford things and even thinking long term, building generational wealth or building a legacy for your family, being able to really build real wealth. So, like, a bank savings and checking is like really the bare minimum. That is the start, that is the foundation. So you want to think about portfolios like using an index account, for example. And it's an index universal life insurance, for example. It's a permanent life insurance that is able to both serve as a saving strategy, and it's also able to give that protection aspect that we were talking about. Okay. Protection in the sense that, God forbid, I was to get sick today, and I couldn't keep a job. It can give me an income replacement. It can give me some sort of compensation. And so when we're also thinking about death is going to happen someday, right? It's just a matter of when. So you want to be thinking about your loved ones and your kids also being able to leave something behind for them so you can start building legacies. This is what a lot of these other communities are really ahead of us when it comes to that, because they already have this long-term strategies and they're just way beyond just using the banking system, because like I said, that is just the foundation. Now, coming to the question of there's just a good feeling. I'm even also guilty of that also. Sometimes it just feels good to see some money sitting in the bank, right? It just feels good. But so what we're trying to do is just this financial education. Why do people feel that way when they look at their bank and they're like, oh, I have this much in my savings, well, I think I'm set, but it's because these conversations were never really brought to us earlier on. So our relationship with money, we treat it like something that we should hang on to, that we should be able to we trust the banking system so much because that is the only portfolio that we were ever introduced to. But in us, we need to come out of that. And that is why we were saying when we started the station, like, we need to normalize these conversations, because when people become familiar with and are educated on the different strategies, and they're able to see how it actually works, then their belief system is going to go high, right? So for example, I have a few accounts, index universal life insurances, which is a type of life insurance that acts as a long-term financial portfolio that can help you like save long-term and really start to build and uses different strategies like compound interest and everything. But I remember when I would talk to my clients 4 years ago, I would talk to them about it. There was a lot of skepticism, right? And there's a lot of fear and doubt, because what is the mindset around when people hear life insurance? They're just thinking death. And that was me too. But it took me to get educated. It took me to get licensed. It took me to read a few books. And then, so, most people, when you talk to them about that, it's like, okay, it's the stereotype that insurance is a negative thing. But when we do that education, and I actually had to go take some money out of one of my accounts and have a check, right, that I could use to help my clients and show them, here is my name, right? I took out $25,000. I am not dead. By God's grace, I'm not sick. This is just my money. And it's like I'm able to build this and protect it from things like inflation and have a higher rate of return and take advantage of compound interest and things like that. So it's definitely something that we're still trying to help people understand, that like, let us be more open and get the right resources and the right information, because that is the only way that we can actually talk about having a good financial vision. The bank savings checking accounts, they're not going to get us there.
Okay, so thank you for that. Because I know that, when it definitely comes to insurance, for me personally, I like being able to control what my money does, right? So I remember a few years back, I thought about getting like few life insurance, for the family, right? When I first thought about that, for the family, and the my holdback was, it was a term life insurance, right? So my holdback on that was, I can contribute to this, and I think that's also some other people's holdback, that you can contribute to this. Yes, there's compound interest is doing work, right? But again, it's term life. So I'm given 20 years or 30 years to die. And if I don't die within that time, then I lose the money, right?
Exactly.
I lose the money. And then if you're doing a whole life, those are very expensive, right? Depending on your age, it's very expensive. So if I do not have a whole life insurance that I started back in my 20s, right? And I'm trying to start now in my 40s, it's gonna cost me a pretty amount of money, right? It's gonna cost me a lot of money monthly. And to me, being a devil's advocate, to me, looking at me putting, let's say, $500 a month, okay, into a whole life insurance, right?
Right.
Why would someone choose to do that when you can invest that on your own? Like you said, that you can get like a tax tax-free account. Like I can go and put it in like a Roth IRA, like an what is it, FTE Roth IRA or something that I'm still getting. And of course, I'm saying this because I have the financial knowledge, but not everybody has that, right?
Right.
So I can basically go and invest it and let it work for me. And whether I die in 20 years, in 30 years, in 40 years, whenever, or prematurely, whatever the case is, right? The benefit of insurance, again, insurance is not like your personal account, right? Insurance is there for the time if, your demise, you die, right? But why should someone get that versus investing on their own?
Awesome. Thank you so much. Thank you so much
So
for.
before I forget that, Nana, so I don't want to forget her question. Somebody just sent a text and said, speaking of investing, so how long does one have to really get into these investments in order to be able to take something out? She mentioned about She mentioned taking out $25,000, but how long did it take her to really invest in what she has to be able to get that amount out? Thank you.
Okay, thank you so much. So I'm gonna start with Nana's. Let me see. I don't think I'll forget the second one. So thank you
She'll
so
give
much.
it again if you forget.
All right. So Nana, thank you so much for that question, because you're really speaking on behalf of most people that have these types of questions. And so why should I put my $500 into an insurance when I can take that money and go to the market by myself? So now, when we talk about insurance, rightfully said, insurance. The primary benefit in insurance is to be able to take care of people when they need it, when life happens. It could be a sickness or death. In most cases, most insurances guarantee a death benefit. Okay, but now we introduce another insurance that has living benefits, which really makes all the difference. And so having living benefits, meaning that I got critical chronic illness, I got even a long-term care plan can be built inside of that, which, like I said, there are things that are definitely going to happen in someone's life. Hopefully you don't get sick, but even if you don't get sick, retirement, old age is coming for sure, death is coming. So this is what separates the portfolio of using this portfolio that is called an index universal life insurance, which is a permanent life insurance, which is able to give living benefits, but it also has some of its secondary benefits that really combines. It really combines a lot of the reasons why people go out and look for different portfolios. So, for example, if somebody has a Roth, okay, a 401k, for example, that is something that is solely for what? Retirement. Okay. If somebody has bought some shares in the market, for example, stocks, for example, they want to take advantage of the market, see when they can buy and sell it and do all of that. We get all these different portfolios for different reasons. But to answer your question is, what if we had something that we could call a financial pocket knife that is able to have all these benefits all in one place? So when we talk about risk management, sickness, this account is able to help you out and give you an income protection, which I think that is the most important even. And then also when I die, I am able to, that money is able to go to my family tax-free. And so I'm able, fine, that money will never replace me, but at least, it takes away the burden, the financial strain that comes with that. At the same time, you mentioned, why don't I go and do investments alone? When you look at this portfolios we talked about today, like Roth IRAs, we just mentioned that 401ks, they all fall under something called the variable environment. Money can grow in 3 different environments. You either have your money in a fixed environment, which is the bank, right? Fixed, it's just fixed. There's no growth. It's just for protection, right? And then you're going to have variable environments. And you want to think of the stock market graph. That is variable. It's unstable. Accounts in this environment and college 529s, all retirement portfolios that are given by our employers, stocks, cryptos, they all fall under that environment. They're called variable because their performance is 100% dependent on the performance of the market.
Yeah, they vary.
So how are you going to know that an inflation is coming, right? How are you going to look at all these things? What if you could take away the headache of not knowing when the next recession is coming and use what we call an index strategy? An index strategy combines both, it combines that protection and it gives you stability in the sense that you have an index account, and an example is an index universal life insurance or a fixed index annuity. It means that I'm making contributions towards my account. And by the way, these are not premiums, you're not paying. They are contributions to you. And a very small percentage of that goes towards the cost of this account.
What's
or
the
the
percentage
that you're using. I it just different. It depends on the company. So I don't want to be quoted to say that it's this percentage, but it's usually anywhere between 1 to 5% out of your premiums, the contributions you're putting in, right? So the majority of that money is now indexed. So this index means that it is not directly participating in the market, but is tied to an index like an S&P 500 or global, whatever other index. But now you're given a cap or maximum, rate of return when the market does well. And then they also give you something called a floor, which the floor is the minimum guaranteed rate of return or the protection part of it when the market dips. That way, you're giving your money an opportunity not just to sit in a fixed environment, but it's also taking advantage of the positive market, changes that can happen. Because what will happen is your money continues to grow in the market when the conditions are favorable. And when the conditions are not favorable, it locks whatever you've accrued and still gives you a rate of return that is usually higher than a 0%. Most of the time it's like, a 1% or 0.75. So what ends up happening there is I am not letting my money sit in a fixed environment. It's doing nothing for me other than just enriching the bank. And by the way, this is what the bank does. It takes your money and uses it as capital to go and invest it in indexes where we are telling you that you can do that yourself. And now when you leave it in the stock market, for example, in that variable environment, you're in that variable environment, fine, it's there in the market, but there's no cushion, there's no protection. But when I index it, so now as I just wrap up that, I just wanted to explain a little bit what makes this very distinctive is like, why would I put in $500 into an account like this while I can go and make the investments into the market so far? Well, you're making that choice is that you're going to be putting it in a variable environment. There are no guarantees and you still have to pay management fees and taxes also. But when I use the indexed strategy, you are maximizing your contribution. By the way, it is not a payment. It's not money that goes away. It's not like a bill. It is a contribution to yourself. And then you are taking advantage of an environment that gives you that protection, stability, and growth at the same time. Not to mention that it gives you living benefits. Get sickness, that is, by the way, statistically speaking, the number one cause of poverty, especially the middle class and the immigrant community in America, is critical and chronic illness and also death. That is when you see a lot of probate courts and things like that. So you have an account like this that's able to do all those things. And that's why I called it a financial pocket knife. It's like a one-stop shop. Now, if you have a 401k and because most people have that, maybe your employer is matching, right? Matching maybe 100%. It's okay. You can keep doing it. That's free money they're giving you. You can match it, but you don't have to do anything more, right? What you could have done more, now you can think of having things like this. You can think of having an account, a private account that is able to do this and this for you. And usually, by the way, when you look at the gap between the middle class and the elites in this country, is just the strategies and the accounts they use to protect and grow their money. And indexing it is the number one way that they're able to do that. Corporations do that. Banks do that as well. And you and I also, we're probably not doing that. I'm not saying you, Nana. I'm just anyone watching me, watching us here, is the reason why. Who doesn't want a good thing that will give them a guarantee and stability and these things? People don't do that. I can say the reason I didn't do that in my past life was just for one reason only, because I didn't know. And that is what we're saying. Financial education, financial miseducation, and the stereotype around the words, the name or the word life insurance is something that we're fighting every day. And so I really appreciate platforms like this, because when we bring about these conversations, then we start to have that mindset shift in people, and then they can make better decisions, and then we all uplift each other as a community.
Yeah. Okay. Thank you. Miss Felicia, you wanted to say something?
Yes. Thank you guys so much. And thank you for giving us this platform to enlighten ourselves, just like Miss Letitia said. We don't want to make it all about like insurance, but when we were talking, we came up with the term insurance and you said whole life, right? So when we talk about insurance, it falls into four main categories. It falls into the group insurance at work, then the term insurance you talk about, the whole life, and then the indexed universal life. So if you listen to the words Miss Letitia is using, she's using indexed. Whole life is also a whole new type of insurance. Yes, whole life insurance is the most expensive of all the insurances because just like you said, you put in money, but then at the end of the day, sometimes if you withdraw money from it, you have to pay it back. Otherwise, it's deducted after you, God forbid,
Mm-hmm.
pass
Mm-hmm.
on, right? But the indexed universal life is totally whole new different insurance that helps you build your retirement. It helps you build for your chronic illness because just like we said, it's a matter of when you will get sick, you will get old. But when you set it up right, it will be there to help you when you are at the point when you cannot work to put in money. And that's
Yeah.
one aspect of savings towards our retirement. You talk about the Roth IRA. Yes, it's a very good portfolio to use, but then the government have a stipulation of how much a person or a family can put in there. And guess what? The interest you make on your Roth IRA, when you are about to withdraw it, you pay taxes on them as well.
Yeah.
Whereas if you use your Index Universal Life, you can withdraw the interest you earn in there is not taxable as well. There are
Okay.
ways of setting them up. That's why you need a licensed financial professional to direct you. We can
So
address everything on just this short time, but yeah, you can reach out anytime and Miss Letitia will break them down. Thank you.
Thank you so much.
I think I don't know if you're done, but the question the person asked was, how long the one has to make
Yeah.
this investment in order to be able to
To be
take
able to check
take
out.
something out.
Yes, yes.
And
Thank you so
yes,
much.
excuse me. And then one there's a follow-up question with that says, and then if you decide to go that route, what happens? Let's say, God forbid, if somebody loses their job and they've only invested in like less than a year of investing, then what happens? But go ahead.
Okay, thank you so much. So it depends on how it's been structured. Okay, but a typical account um, will be 2 to 3 years. You're able to take some money out. In my case, I took out $25,000 within I think 18 months, but it didn't affect my account. Still, I still have it to this day. So I was able to take some money out because remember, it's building cash value. It's compounding. So at some point, you can have, when we're talking about that liquidity, that you can take some money out when you need it. So the goal is usually to be used as a long-term financial portfolio. Okay. You don't want to be putting money, you don't want to start it and then you're thinking, oh, next year I will do this and that. The goal is to contribute for as long as you can, because the more and the longer you contribute, the more cash value you're gonna build. But then it can also be structured in a way that, hey, I want to take some money out this year. Yes, you can do that. What you can do is you are allowed to contribute more than you are required to. So let's say we structure something for like 300,000. That is the face amount, the coverage amount. And this person, let's say in a whole year, they're putting in, maybe I'll just throw in a number depending on their age, maybe 1,500 or 2,000 a whole year. That is going to be the target premium or the target contribution that, based on the coverage they're taking, their age and their gender. By the way, females are cheaper. Just an FYI. As you are, right? So let's say the annual premium or the annual contribution that you're allowed to put in that type of setting is $3,000, but there's going to be something called a 7-pay. 7-pay is the maximum contribution that you're allowed to contribute into that account in a year. Okay, so this is and it can be like 15,000. Let's say it's 15,000. Now, what I am required to contribute here is $3,000. But if I have extra money sitting at
For the
bank
year?
for the year, I'm just giving an example, right?
Okay.
So yeah, let's say it's a 300,000 coverage, and the person is 30 years old, and their annual contribution that they are supposed to put into this account is $3,000. $3,000 is what they are required to put in to continue having that portfolio the way it's been set up. But there is also an option. It gives a lot of flexibility. There is also an option to put more money in. So say somebody has some money sitting in a savings account. We've all understood that the bank is just using your money to use the same strategy to build money for themselves, right? So you can, and the figure here that I'm giving is 15,000. Okay, that is an optional thing that you can do. So you can contribute more, and anything that you contribute outside of that target premium that you're supposed to put in for the year goes into your own index account. It goes to compound for you. It goes into the savings account within this policy. So most of the time, this rate of return is anywhere between 8 to 9, 10% per annum. Okay, so now you're able to build more cash value sooner than somebody who just decides to do the bare minimum, right? So that also means that you're gonna be able to dip into that. You can go and have access to some of that money sooner than somebody who just puts in, that bare minimum. Does that make sense? So in my case, I was putting in a little bit more contribution. That's why in those 18 months. So it can be structured in different ways. But I always tell people, you don't have to be super wealthy. You don't even have to have a lot of money to be able I tell people, just start where you are. Once you have that, get approved and you have that account, then you're able to even understand it more and some of the other ways that you can structure it depending on your financial goals. So you can have access to the money in the first year, or you can have access to the money in the third or fourth year, depending on what your goals are and how you choose to make contributions to your own accounts, right?
Okay, so I'm sure there are like withdrawal fees when you try to make a withdrawal. What does that look like?
Yeah, so with the withdrawals, like it also depends on the type of. So you can accessing this money, you can either do a withdrawal or something also called, the other alternative is the loan option, right?
It's kind of like a 401k.
Yeah, I think a 401k has something like that as well, right? So when you do a withdrawal, this withdrawal, is given against the cash value that you have growing in. And so when it comes to fees, let me just talk about fees in general. With the withdrawal, you're going to have, if you are withdrawing something that is less than your contribution, let's say it's year 4 and I have contributed maybe 12,000, but because it's been compounding, then I have more money the cash value is more than that because it's grown, right? So maybe I need 10,000 out of that. If I withdraw 10,000, then I'm not subjected to any taxes. I don't pay taxes there, right? For example. But let's say I'm taking in more than what I've contributed. I contributed 15,000, for example, and I want to withdraw 16,000. Okay. 15,000 out of that is going to be tax free. I only get taxed on the growth, which is 1,000. And so why? Because they are looking at this as already all the contributions you put in, they came from somewhere. You already got pre-taxed. So that's why I said when we're talking about taxes, you want to go for accounts that don't double tax you unnecessarily. So then you're able to do that. Now, the other option is you can decide to have access to this money by using the second option where you don't pay any taxes at all, and that is the loan option. So the loan option, loans are not usually taxed, but
But is there like a withdrawal fee? Not
yeah,
tax
there's
You
withdrawal.
don't think you have to pay it back since it's a loan?
Yeah, you
Pay
have to
it
pay
back to
it back,
yourself?
but you do have to pay a fee.
Yeah, so it depends on when you're doing it. If you do it the first 10 years, the fee is usually so again, there are many different types of loans. There's fixed, there's variable. There's different companies that have. So I'm just talking in general, right? Just in general. So when it comes to the withdrawal, the loan fee, depending on where I'm taking it. Most of the time, in most companies, if you're taking the loan or having access to that money within the first 10 years, then these the withdrawal fee is usually slightly higher than from year 11 to to the rest. So for example, could be like a 2.75%, in the first 10 years. And then if you're doing it from year 11 or whatever, then it's 2%. Yet again, compared to the kind of, fees and the interest that we pay in a traditional way when we want to access any loans, then that is really nothing. And then also when it comes to whether you will have, so it's a loan, does that mean that I have to pay back? Because of course, when we hear loan, it's like, okay, I'm taking a loan, it's a loan, right? I have to return it. The answer is no, you do not. Is it advice to do that, to pay? Because when you think about it, you are taking this loan, you are accessing this money, and it's your own account. So you're really doing it against yourself. So whether you want to do that or not, it all depends on you. It all depends on you. Felicia, I see you nodding. Did you want to add something?
Yeah, I was gonna say that if you have been saving into your account like for, like you said, less than 10 years, then it's of course 2.75. But then that fee, it comes back to you as well. And if it's more than 10 years, you pay just 0.75 or 2%, and it comes back to you. And just like the loan, it's your own money. If you want to put it back, it's gonna grow for you. But if you don't put it back, it really don't go against you. It's just whatever you have left there, that's going to continue to grow, which might maybe slow you down. So normally it's a good idea to pay it back if you can. But if you cannot pay it back, they don't penalize you for that.
Yeah.
Okay, so it kind of worked the same as doing a loan withdrawal from like a 401k.
Yes.
Where if you pay back, you have to pay it back, but it's
Yeah.
basically coming to you. You're not
Yes.
paying it to but it has
Right.
like a life insurance aspect of it,
Yes.
where you have like a fixed rate where your rate will never go under, but then it has like a valuable aspect of it where if the market is doing good, your account is doing good. If the market is not doing as good, then it's not gonna drop as low, basically to like negative where you're actually losing some of your principal that you put in.
Okay. So also with 401k, I have both. So I understand both. With 401k, when you loan from it, you have to still be current in that company and you have to pay it back. They give you specific number of years that is comfortable for you to pay it
Mhm.
back. But with your indexed account here, they don't give you any years to pay it back. You see? And it's for you in case you pass on, whatever is left in that account plus your benefit, which is the debt benefit, is still there intact. For instance, like she said, $300,000, right, as a debt benefit. With your growth in there, whatever is left on top of the 3,000 is what comes to you. It's not going to affect your debt benefit at all. Whereas in a 401k, if you borrow and you don't pay it back, they're going to deduct it from the amount left before they give you the rest to your family. So that is also another difference between the two accounts.
Okay. All right. Thank you so much. It's very insightful. I didn't know a lot about index funds. What is it? Life insurance? Is that
Index Universal Life Insurance. Yes.
index universal life insurance? Okay. Yeah, I
Mhm.
think that, of course, our whole program for the month is financial management. So we're looking at our financials in the bigger aspects, being able to get from the mentality of just having a checking and savings, right? As
Mhm.
well, a lot of people have their 401k, but literally, a lot of people have checking, savings, 401k. That's it.
Mhm.
Many people, that's
Mhm.
it. And we rely solely on that 401k. But
Yeah.
what I've learned is that look at your lifestyle right now, right? You look at your lifestyle right now and see how much you will need at the time that you retire to be able to maintain your lifestyle. Because when you don't have like a regular paycheck coming in, but you still have the same amount of bills, how are you going to survive, right? So I see this fund as another account that you can add in your bucket. As much as you have your checking, you have your savings, I believe in having, yeah, your
Like a
401k.
backup, an additional.
I also
Yeah.
believe in having your, tax advantage accounts, such as the Roth IRAs, even, having traditional IRAs. Try to fill all those buckets. And also, because when it comes to specific, I'm relating the index universal life insurance to kind of investment. It's still an investment into your life, but on a long term, whole life base. And I think that it's a good option to add on. I don't think that it's like, well, if somebody needs more information, they can contact you about it, and we do have the information, the contact information on the screen. But what I was saying is, I don't think that it's something that we should go in with the mentality that
Mhm.
it's going to be something I'm going to be taking withdrawals from, because I don't think that's what this is meant for. Even though you have your cash values and you have all that, from what you're saying, I'm looking at it
Yeah,
more
yeah. You have to now that you have to think of it as a long term thing, not
it's a
just,
life
yeah.
insurance
It's a
at the
life.
end of
Yep.
the day.
Long term.
It's
Yeah.
Absolutely.
Yep.
Yeah.
it's a life
It's my
insurance. So we're
yeah.
not, I don't want people to think that this is where you can go put some money and then
Yes.
tomorrow you need some emergency fund. You're like,
You
I'm
run
going to
there
touch that,
for
because
every, yeah. Yep. For every
there
little
is
thing. That
going to
makes sense.
be replication for taking money out and all that.
Yeah.
So you should, yes, you should have it with all of your other accounts, but I can see where people are like, oh, she took 25,000 out. Let me go start investing and save some money so I can take this out to go build my house. That's
Yeah.
not what this is for.
Yeah.
This is
Yeah.
a
Can I
life
say something
insurance.
real
You have to
quick?
look at it as a life insurance.
Sure.
Yeah. Can I say something real quick?
Mhm.
Um, so yeah, thank you so much, Nana. I'm so glad you clarified that. Also, I wanted to also say here that this is not an investment account. It does work like one, but think of it as like forced savings. It's like it's a saving strategy that is able to give you, you know, it's able to give you that return that you will get when you make an investment. So, because obviously, whenever people contribute or are, pay towards something, they are expecting that they want to take it out. That is a very natural, it's just a human thing. That is one of the very first questions that I usually hear when I structure my clients' accounts. And the first question after you present, they say, when can I take it out? You understand? So that is okay. But I want people to understand that, you know, at the end of the day, it is a kind of a life insurance, a permanent life insurance that gives you living benefits. The primary function um, is that it's insurance, okay? But it also has great secondary benefits. By the way, we just mentioned a few of them.
Yeah.
It has way over 60 benefits. Well, some of the others we don't have time to talk about that here, but like the Nana and Lady Mary just mentioned, we just wanted to give kind of just information generally, but we'll be more than happy to sit down with you and have those conversations, which are complimentary, by the way. We don't charge for that, to make sure that you're set up. But there's some of the secondary benefits. They're gonna protect you and your business, if you have one, from things like lawsuits and bankruptcy. So let's say somebody files, they will protect you also from the probate court system, which when we all die, as long as you live here in America, you have a social security, all your assets and all your accounts go through the probate court system, whether you had a will or a trust or not. And this is a system where it's been set up by the federal government to be able to protect the interests of the government and your creditors like the bank. So when people pass away, they're able to have all those accounts and do an audit, and it goes through a court system to make sure that you don't have anybody's debts. People always think when they die, the death goes with them. But I always tell people that's when they actually resurrect. So you want to
settle away your estate.
You want to be first. Exactly. You want to be using strategies right now that are protecting you right now, and they're still going to protect your assets when you die. This is one of the very few accounts that's able to do that for you. So I just wanted to stress that it's not an investment account. And you want to think of, fine, we're asking questions, when can we take the money out? But I want us to shift our focus from when can I take my money out, and talk about the vision, the bigger vision. If we're talking about financial planning and building legacies and building real wealth in our communities, we ought to be able to think beyond when can I take out $1,000. We want to think about all the 5 stages of building wealth. The first one is you earn. All of us earn here. At least I hope so. Whether you have a job, you have a business, you have some earnings coming in. And then we talked about being able to save. That is where a lot of us go wrong. We use the wrong strategies. But beyond savings, then we want to think about being able to grow. And then we talked about protecting. And what is the final stage of building real wealth? After you protect, you need to be able to transfer it. Transfer it to who? Your family, your kids. And so the final stage is transfer. That is like the 5 steps of wealth, right? We just talked about some of them today. So you want to think about an account that is able to protect you. And even when you die, it's able to help you transfer that wealth, and you don't lose it to the system through the probate court system. You can imagine living all your life, paying all these taxes, working hard, 2-3 jobs, paying taxes, and then, you die in your 60s and 70s, and now you're leaving behind some money in a 401k, some money somewhere, but the same person, you have some money in your savings, in your 401k and in your bank, but this same person has a mortgage they hadn't paid off. And so the probate court system is there to protect the interests of your creditor, who is the bank in this case. And so trust me, that money you're leaving behind, it's not going to end up in your kids' hands. It's going to go to the system. So you need to know well, because the people that win in this America, it is not just enough to come and set foot here and say, I made it, mom, I made it, dad, I got a green card, now I'm here. What we're telling people is, open your eyes and let us also learn the strategies that the elites use in this country, so that it's not about how much money you make, but how much you're able to protect, how much it can work for you. So it doesn't matter whether you're making $30,000, $40,000 a year. You can always start somewhere. Using the same strategies, using the right strategies is far much more better than making $200,000 and you have no clue about how the system works. That's all I wanted to say, but thank you so much for having us. We look forward to seeing some of you here. We want to help everybody to make sure that they are properly set up for this year, because the choices that you're going to make today is really going to be like the life that you choose for yourself and your family tomorrow, right? Thank you.
Thank you so much, Nana. I think it's been an amazing session. It's always very good to really get to have the understanding of all the different, aspects of finances. I think most of the people, almost everyone, there are people that are actually working, in these corporations, but then they don't even have 401ks. They don't have other, they are not looking at any of that. So I think that it's a good start for us to be able to have this kind of conversation ongoing. Nanaya, do you want to say anything before we end? And Miss Felicia, I don't know if you want to say anything before we end our session. Nanaya, do you want to say anything before
I'll
we
have
end?
Miss Felicia go. Miss Felicia, go ahead.
Okay. I just want to say thank you so much. And we thank you guys for having this kind of platform for us to come here and also share and also learn. Because as we learn, that is how it's going to set us up for 2026 and also for the rest of the future. And I want to thank Miss Letitia also that you came in and helped me out to let everybody know that we have other ways of savings and other ways of investing and also other ways of earning that we can also use. Thank you.
Yeah. And if
And
you're
thank you to the
interested in
audience
any
as
of the
well.
stuff they talked about today, please message the chat room, show Miss Mary's page, or send a
Yeah,
message to the WhatsApp platform, even
yeah,
on YouTube,
yeah.
and we will
Get
directly
connected.
send you information. But I will also have the Tish, if you can go ahead and tell them your contacts. So if anybody's interested.
Absolutely. Yeah, so my contact, I think, yeah, it's right there. 469-325-8752. I can also be found on all social media platforms with that name, but I think the easiest thing is to just text me. Go ahead and text me right now and introduce your name, yourself, and then we'll save your number and then we can go from there. 469-325-8752.
Is that website also?
Yes. Can I type it here? Is this, can everyone see this?
You can type it and we'll
You
copy
can
and
type
paste
it,
it
she'll
later.
project it.
Okay, I'll
Or
type
you
it.
want to, are you, which one are you talking about? The back
The
stage?
backstage is not, unless she's typing it on Facebook or YouTube. But just send the link.
Go
Send
ahead
the
and put it on the
link.
backstage. I'll put it on Facebook.
Yeah.
Okay, sounds good. Mhm.
Yes, but Miss Felicia, thank you for having us. Nana, thank you. I'm looking forward to next next Sunday's conversation. We have a good start for the year.
All right.
Okay. So whilst Miss Letitia is doing that, once again, thank you all so much, Nana. We appreciate you. I see Professor Felix joined us today. He's all the way in Texas. I hope he's still there. You never know where he's at. All right, Felix, the professor. Thank you for tuning in. I think it's Perry K. Thank you for tuning in. Kojo Bento, thank you. Riti is joining in from Dubai. Thank you for tuning in. Mary, thank you for following. Ebenezer, you're welcome. We appreciate you all. Thank you so much. If you have any questions, please don't hesitate to inbox us and we will do well to make sure that they get your information. Well, I guess this is where we end our session for today. Thank you so much.
Thank
Nana,
you.
did you get the email?
I did.
Yes.
Okay.
Yeah, I'm trying to, I kind of lost you all. Oh, okay, here you are. I see it now. Okay. I use Zoom a lot. This is my first time using this platform. I'm actually liking it.
Thank you, guys.
Mhm.
Thank you so
All
much. We
right.
got it.
So
Sure.
I will.
Thank you.
Yo, yo, yo. Now your matter with the talk. Your life, your wahala, your breakthrough, idea. Welcome to the chat room.
This no be ordinary place. Now a solution they show face. Lady Mary, they lead the way. sword, you gon' feel the burn. Oh, the chat room. Now here we define the way. Oh, the chat room.
Oh yes.
We go talk and clear, no delay. No delay. Oh, it's interactive, educative, informative, and unapologetic. Oh, the chat room.